Ladies and gentlemen, welcome. This is Christopher Aaron. It is the 29th of June, 2016. We'll be looking at the fallout from the Brexit vote today, putting that in perspective on the charts, trying to stay as unemotional as possible and let the charts dictate the action, the unemotional language of the charts, because it allows us to stay as clear-headed as possible, even though these are very emotional subjects, to be sure. Anyone in Great Britain or the United Kingdom, rather, I'm sure this is a very charged time period over there. I am not a member of either the EU or the UK, so I don't have an official opinion on that, but we will let you know some of the movements that we've seen over the last couple of days in the markets as related to the Brexit fallout. This is a very important time. If you are tuning into this for the first time, if you are starting to become educated on the precious metals, this is a very important time for that. There's always new waves of interest when we see these spikes up in gold and silver, as we have seen. And if there's one message I could take to you if you're just starting to learn about this, it's that the moves are not over. There is a new bull market that is underway. It's been getting going for about the last half of a year now, but most of the signals are showing that this should be lasting into the next decade. Of course, with a 2 steps forward, 1 to 2 steps, sometimes even 2.5 steps backward. These markets often retrace and make people get a little bit anxious in the short run. So anytime we're feeling most bullish is when we should step back and take a look at where the next retracement might come in. So once again, if you are new to these markets, welcome. And I do think there is tremendous potential ahead of us as we let these moves unfold here. And just for example, looking at the fallout from the British vote, I'm kind of sick of hearing about this, to be frankly, and I'm a little bit tired of talking about it, but it really had a tremendous impact in the markets. We're looking at, this is the chart from last week of the British pound versus the euro, 5-day time horizon for the week, and we're looking at the fall of the British pound versus the euro on Thursday, the day of the vote. And of course, the pound fell from roughly 131 down to 122 and change on the vote. Now, that was a 9.4% drop in the value of the pound versus the euro. And for perspective, when we see 1% moves in currency markets generally in one day, a 1% move is considered a large move. For the currency markets to move 1%, you are talking hundreds of billions of dollars or hundreds of billions of pounds or euros that are getting sloshed around in one direction or another. So for over a 9% move in one day, this is a generational type of move. Moves like this in one day happen maybe every 10 or 20 or 30 years. So we are really looking at something extremely powerful here that is developing. This was a flat-out fear reaction in the markets. It was a get me out, I don't care, I want out type of reaction from people holding British pounds. And so when we look at just another cross pair, we would think it to be a less relevant cross pair, but it actually is quite relevant when we look at the British pound versus the US dollar. Of course, the US dollar not directly involved in this vote, but it is because in the short run, the dollar acts as a safe haven in these types of scenarios. That is, until the markets begin to focus on some of the underlying problems with the United States currency, which it is not doing yet. So we see here the British pound falling from 150 to roughly 135, over a 10% move, a 10% loss in value in the British pound versus the US dollar. Again, we're talking multi-decade strength of these moves here in terms of their magnitude. So we are living through something historic. This is not something that you see every day. And the thesis that I am proposing is that what we are seeing here is a move that is representative of moves that we will be seeing in other currencies over the next several years. And essentially what we are seeing is a slow but sure awakening amongst market participants as to the inherent worthlessness of all fiat currency. So really, as we see, for example, here today, we have the British pound, people selling pounds and rushing into dollars. But let's imagine once this settles down a few years from now and the market begins to realize that the US dollar is also inherently worthless. What is going to be the last man standing, so to speak? It's going to be gold. And of course, silver. The two currencies that we know of that cannot be printed at will by anyone. So over the course of the next 5 to 10 years, I expect there to be many more of these types of moves in the currency markets amongst different cross pairs. Who knows what will be next? Could it be another member of the euro leaving the EU and then the euro falls against the dollar? Could it be a problem in the United States? Could it be low oil prices contributing to a weakening in the Canadian dollar? We don't really know what the fundamental sparks will be, but we can see the trend. We can see the writing on the wall. So right now, of course, most people are still very much unaware of the possibility or the reasons why one would own physical gold or silver or any form of gold or silver. But this will be an increasing awakening, a consciousness awakening of sorts, I believe, in the metals. Now, gold has broken out of the consolidation that we have been watching. We will now turn to the charts and look at the action. We have been watching gold, and we don't see it here because the move, this is a 3-day chart. The move occurred last Thursday. We will put that in perspective on the next slide. Now, silver lagged on the move, but we see here today silver playing catch up a little bit, closing above $18 for the first time in a very long while. Some important junctions here for the metals. When we look at gold, we are now looking at the 1.5 year time frame of gold in US dollars. And mind you, it was only a few weeks ago that gold had fallen all the way back toward the support zone near 1205. We had a rise out of that and a false breakout. We were talking about this at length in the last video. A false breakout above this 1305. And then what would happen after a false breakout? We said there would be some sort of a return into the middle of the prior consolidation. And sure enough, so we came back down to 1252 and then boom. This is a legitimate breakout. Here was the resistance zone. It was defined by the high in January of 2015. Bring that all the way forward. We can see in February, March, the price got close to that level. That was the first attempt defining the lower boundary of this resistance zone. Price then backed off, attempted again in late April, getting right to 1300, attempted again in June, made a false break, and then the fourth try, the legitimate break. So we now look at this as a 1.5 year consolidation in the gold market. We now have a new set of primary trend channels shown by the royal blue color here. This trend is valid until the market shows us otherwise. So this is how the type of analysis works that I perform. I'm very big on trend lines. I'm very big on relative strength, gold versus an index, in this case the CRB commodity index, which is an index of a few dozen different commodities, including the rest of the precious metals, soft, agricultural commodities, energy. So we're looking at gold versus the rest of all the commodities. I'm very big on volume patterns. We see in the breakout here from Thursday roughly 2 times greater volume than average. Notice this was the single highest volume spike in a year and a half. So when we see a break of an important resistance zone on high volume like this, it is an even stronger signal. This is a legitimate breakout. So what will we expect in the short run? Another thing that I pay attention to, just to show this here one more time, is the Fibonacci retracement level. So basically, we take from the bottom of the move, we measure up to the top of the move in question, which has now been raised to 1362, which was the intraday spike on Thursday into Friday morning. And this becomes the move in question. And then shown here in the very light gray lines, we have Fibonacci retracement lines, of course these being representative of those patterns in nature that were on the video from a few weeks ago. Seashells, waves, flower patterns, hurricanes, over and over we see these patterns. So all we do is we move these up to the top of the move, and this gives us an idea if there was going to be a sudden correction that we're not expecting. This would give us logical places to look for that support to come in. It's sort of a preemptive look at where we should look for support if this was hitting an intermediate term top. Signs point that this is not an intermediate top, but this is a legitimate breakout. So on this breakout, what we would expect now is to see this zone that was acting as resistance, 1285 to 1306. This zone should act as support on any further weakness. We actually saw that yesterday as the price bounced right at 1305. So on any further weakness, this should hold as support. We would now be looking at a 1 step, 1.5 steps forward, 1 step backward, 1.5 steps forward pattern. Mind you, this is all occurring during the weak part of the year, the very weakest month of the year, June. Really tremendous. Tremendous relative strength being shown here. If gold can basically consolidate these gains over the next 6 to 8 weeks, I think we're setting up for some real big fireworks by late August or early September. Switching over to the silver market. Now, taking into account the surge that we saw today, we are still in a slightly different scenario for silver. If you are new to the metals, one of the major themes to come to understand about the relationship between the two metals is that silver lags gold, especially during the early part of a bull market. And we are in a new bull market now, and so we see, for example, gold had exceeded the January 2015 high. Silver is still yet to exceed that high. A brief spike above that before closing back below it today. We're generally concerned with closing prices. So the resistance zone, the immediate resistance zone here, right above $18, we would hope to see that hold. Although it really wouldn't surprise me if gold needs to retest the 1285 to 1305 zone. It would not surprise me to see silver perhaps need to back off back into the 17s, even the mid to upper 16s again. Hopefully closing no lower than this rising blue trend line here, which formed from the lows, from the bear market lows. Now, the bigger breakout in silver is not shown on this slide. That's going to be on some of the longer term charts that we'll save for next time. But that resistance zone is actually slightly higher than this at 1850. It comes around 1875, and that represents a swing low from about 3 years ago. So that is the real critical resistance level, 1875, that we're watching now. When that breaks, I'm expecting a surge in silver in not too long, somewhere into between the 2150 to 23 level. That could even overshoot to roughly 25. But it's not clear yet. There are mixed signals at this point. It is not clear whether or not silver is ready to do that now, or perhaps it needs to back off for the next month or two before making another attempt above 1875 in the early part of the fall, perhaps the late part of the fall even. Either way, it's very exciting to watch the beginning stages of this bull market play out, and I would encourage you to just keep your ears open and see how many people you know of in your real life, not people that you read about on the internet or YouTube, but how many people do you really know from work or the bar or soccer practice who are accumulating gold and silver at this point? The executive summary support between 1285 and 1305, 1306 for gold. Resistance is now 1362. We're working on that. Silver just stated support at 16, resistance 18 to 1875, and we are watching some significant moves in the precious metals equities. Of course, they all move at slightly different trajectories. If you want just an average of all the mining companies, you can certainly buy the GDX or the GDXJ. There are sometimes outstanding gains to be made from the individual companies. Thank you very much for watching. There are some people who are asking for examples of the types of trades that I will be doing in the silver trading service that is getting closer to being launched. It's probably within 2 weeks or so. And I would encourage you to go back and watch those videos from a month ago when I was talking about the silver setup that I saw and then announcing that silver trade publicly. Those are going to be the types of trades that the service will generally feature, but the alerts will come in a much quicker fashion. You won't have to wait for me to produce a video and upload it and process it and all that. I will be doing it in real time via email and SMS message. But they will basically be trades that can be either executed in the futures market, in the options market for the SLV fund, or in an unleveraged ETF market such as the SLV itself, depending on the individual risk tolerance. And I'll be disclosing in exact real time the precise buy and sell point of the exact trade that I'm making at that time. So that's how that will work. And I foresee there being a lot of opportunities for those sorts of trades over the next several years into the future. Thank you very much. Have a lovely evening, and I will see you this time next week.